Log on, tune in, find out. Another good idea from Cambridge.
So, actually, before I start, I suppose I ought to say I've had an office in St John's, and very convenient and useful it was too. The thing I like about the Ignite course, in the company I helped co-found, one of our mottos was hard work and fun, and you'll certainly get that out of the Ignite course if you attend it. The other problem I've got is it's a huge topic, getting funding and understanding investment methods. And I'm only supposed to be talking for 15 minutes, and I can talk forever on quite a few subjects associated with starting businesses. So what I really am going to try and do is just give you a flavour of what's involved in raising money. And fundamentally, you've got to think a little bit like, well, there's an old salesman's joke. What's the difference between a buyer and a seller? And the answer's about a meter. What does that mean? Well, some of the time, we might be buyers, and some of the time we might be sellers. Some of the time we might be entrepreneurs looking for money. Some of the time we might find ourselves, like me, on the other side of the table, representing a VC and being prepared to invest money. And one of the challenges, I think, is that if you are out there looking for money, you've got to think like the other person. You've got to think, what are their care-abouts? What are their issues? It's not just some blind hope that maybe if you kiss enough frogs or see enough VCs, they're going to give you money. You've got to understand them and target your work, because really, if you're growing a business, you ought to be focusing on the business, not on raising cash. This slide, I can't say I've been totally comprehensive in finding and putting down all of the sources of funding, but one of the other things that you really should think about is if you're going to be entrepreneurial, being entrepreneurial isn't just, I will have a business idea, I will then go and present it to some angels or some VCs, they will give me some money, then I will do something with it, then I will get some more money, and then we will sell the company. That's a very conventional way of thinking. And very few businesses are necessarily going to follow that path. And indeed, if you really want to be entrepreneurial, perhaps it's better not to follow that exact path. Perhaps there are things you need to do, or you can do, that will help you change the path, but actually be more successful. Create a business or create a venture that is more successful in terms of what you manage to achieve. And one of the things you have to start with is sweat equity. Basically, what it means is you just do the work for free. And it's not uncommon for businesses to really, most of the time, start with an individual or individuals who've got an idea, maybe they're working already for a company, and in their spare time, they go and build their idea, develop it, and work upon it as they're gainfully employed. Now, there are pros and cons of all of these approaches. Of course, one of the cons is you don't actually have much money if you need to build things. You've got to beg, steal, or borrow. The other thing you've got to worry about is IP. Very often you'll find your employment contract has some constraints about what you invent and whether the company owns them or not. Now, they can't completely own your brain, but you've got to make sure that things you do don't conflict in terms of the evening work with what you do as your day job. There are competitions and grants, and again, what you shouldn't do is, this is not about spending all of your time and focusing on raising money. It should be something that helps you, but it's incidental. It's not really a measure of success. But competitions and grants can be very good ways of both raising your profile, getting people aware of you, helping you to survive without really needing much cash. So there's nothing better than a VC coming up to you and saying, you're looking for money. No, we're not looking for money at the moment, but we've got some exciting things happening. And that's what competitions and grants can do for you. And indeed, the European Commission is keen to assist companies, or has been keen to assist companies. And some of the companies that I've invested in have been very successful in eking out the valuable cash. Because when you raise money, effectively what you're doing is you're selling a bit of your business in return for that money. That's actually very expensive way of raising money. It might not seem it, but it is a very expensive way. If the company's successful, you'll look back and think, wow, was that worth it or not? If you can make that money last, you're going to be more successful. Friends and family, one of the issues here is, of course, do you feel good enough about your idea? Do you think it's a potentially successful idea that you really want to persuade your friends and family? If the idea isn't successful, you're going to lose some friends and you're going to lose some family as well. It can be an issue, but a lot of businesses have started that way. Angels, typically high net worth individuals who have been successful in the past and are willing to put a little bit back in. They want to have some connectivity with the industry. They want to support interesting people in being successful. Typically, they're going to put smaller amounts of money in. Let's say anything up to about $1 million, not necessarily individually. Some will do that individually, sometimes as groups. Here in Cambridge, we've got people like the Cambridge Angels who have actually organized and are more able to put a united front. The pros are you can actually tap into some individuals who really can not just help you with the cash, but can help you drive the business. You can also find yourself with a roster of investors, and actually some of them can be impossible to ever get hold of because actually they're very busy people. And you get this half-life of interest. They're interested at first, but then they'll move on and be interested in something else. So it's got its cons as well. VCs. Now VCs actually raise money. They'll put some of their own money in as well, but they raise a lot of money, hundreds of millions of dollars, and then invest from that. And they do this not just for themselves, but also for their investors. Grown-up angels, if you like, although not sure I'd say that to some angels. And they have care-abouts and focuses. Some will be interested in particular market segments, some will be interested in startups, some will be interested in late stage. You've got to know, if you're going to approach VCs, which ones are the right ones for you and your business, and at what stage should you be approaching them. There is no point in sending a business idea or a business plan to hundreds of people. VCs gossip, they talk to each other. If you're shopping your idea to everybody, then it doesn't look like it's going to be very exclusive. On the other hand, if you shop your idea to one or two people and others get wind of it, you create a bit of demand, that's going to be a more successful way of raising cash. Debt. Debt has kind of fallen out of fashion, but it wasn't that many years ago where people would start businesses by basically putting their houses on the line in order to drive them forward. And still, in venture-backed companies, it's not unusual as a later stage to use debt to fund the company, typically when there's something the banks can then get back if the company goes bust. It's cheaper in terms of the amount of equity you expend in order to get it, but it has its risks and it has its place. When you're selling, you can even raise cash on your invoices. So you sell to companies, you're not going to get paid for some period of time, but banks will lend you against that. Supplier credit. If you buy things, you can get your suppliers to give you credit. And these are all ways of mitigating giving away chunks of your company. Customers. Well, customers will also invest in companies. ARM was a company that was started because Apple was prepared to put some money in to help them get going. And Apple became a customer of the company. Equally, I actually like the idea that sometimes maybe you start working with a company as a consulting operation or whatever in order to drive it forward. As I say, they've all got pros and cons. It's a lot more complex, really. I have to say I favor the idea of customers because it validates your idea, it gives you credibility, and too often entrepreneurs get so focused on the technology that they end up not making a product. If you can build something and get an early customer, a teacher customer if you like, to work with you and make that product better, then you're more likely to be able to persuade other companies to come in and use it and actually not need VCs or be in a much better position to negotiate the value of your company with respect to VCs. Talk about empathy. I think it's vital that you do have some understanding of who you're trying to raise money from, whether it's banks, VCs, angels, or what have you. I suppose if I look at VCs, VCs have an investment strategy. They've had to have, in order to raise money, they've had to go and persuade development banks, pension funds, etc., that they know what they're doing and that they can take their money and they can then give them back even more when they finish their investment cycles. VCs have investment cycles, and so typically if you raise a couple $100 million, you're going to invest through a certain period of time, and when you invest in companies, you always make reserves for the company if the company's going to be successful, so you can put more money in. And these things have got cycles. And if you go to a VC at the beginning of their investment period and you go to them towards the end of their investment period, they're going to have very different views. They will also have a portfolio of investments. So if they've invested in particular spaces, and then you go and ask them to invest in your company, which is in a space they've already invested in, they might well not be receptive. Not because it's not a good idea, but because it's not appropriate for them and their particular investment portfolio. Equally, of course, you can also get market issues. So if the market's got a downturn, maybe they're going to be more reluctant to invest in you. And I think one of the things you've got to recognize is if you're desperately having to go to lots of VCs, word will get around and it's going to make your life much harder. And believe me, success is not raising money from VCs. You can't spend time trying to get a VC to invest and then relax when you've got the money. Actually, the hard work's really got to start when you get the money. So as I said, a VC's goal is to make money for their investors, and they view a success as basically putting a chunk of money into a company and getting a 10 times plus return on that investment. And they also expect companies to fail. Failure is not a problem, it's something you have to manage. But the ideal is a VC wants to put a lot of money into the successes and actually starve the companies that aren't going to be successful, turn the tap off as quickly as possible. The other challenge is that, and this slide is out of date in the sense of, I did this last year, this company has gone on to raise even more money, but this is a silicon company, and each of these was one of the rounds. So they got $1 million at the start as proof of concept, and they've raised more and more money from VCs, then moving over to equity and debt finance towards the end. And you can see if you've put $170 million, now several hundred million dollars into a company, it's going to be much harder to get that back. And what VCs will do, in fact, what any of those sources of funding will do, perhaps apart from competitions, is they're going to have to understand the risk. They want to understand the risks in your technology. They want to understand your market readiness. They want to understand all of the issues. They also want to look at it and say, how mitigatable are each of those risks? Things always go wrong, and sometimes you might find you're just asked lots of negative questions about your idea, but it's really your potential investor is trying to understand when something does go wrong, what's going to happen? How are we going to respond? What are we going to do about it? And at the end of the day, is the risk versus the reward an acceptable trade-off? The other thing that venture capitalists are going to do is due diligence on you. So they might well agree to invest in you. You will sign what is called a term sheet, and essentially then the harder work begins, and the VC, either themselves or with the aid of others, will crawl all over your company or your potential company with a fine-tooth comb. Is your IP acceptable? Have you got employment contracts? What are the issues associated with the company? In order to then decide, are they really, really going to put the money in? So you must make sure that you are ready for that level of scrutiny and you're ready to be able to take and answer all of the questions. And it's not just a checklist, and I like this one about Lehman Brothers. Basically, the day they filed for bankruptcy, the 3 major credit rating agencies had still got them at A or better. I won't do the advert because we've heard all the adverts before, but the pond approach is hand-on. It's also a two-way activity. You do your homework. If you're going to raise money, just as you will be looked at and scrutinized, scrutinize the people who are going to lend you money. Are they going to be honest? Are they going to be there with you in the tough times? I talked about this sort of half-life of interest. VCs have it as well. So when your company has got to a difficult stage, but they've invested in something even more exciting, are you still going to get attention that you need and deserve from them? And then finally, I think you've got to be able to communicate. You've got to be able to communicate the essence of your idea, the essence of your company, the essence of the potential, and you've got to be able to do it succinctly and effectively and with passion, and you've got to be able to learn to draw people into your ideas. And you've got to be able to read them. You've got to be able to understand, is this VC just bluffing? Are they just having me on? Are they really interested in investing in my business?
I'm going to come at this from a slightly different perspective. I've set up and run 5 different companies. 2 of them were in the UK, 3 of them were in the US. Some were high-tech, some were not high-tech. One of the things that I've learned, as you know, I've just written this book, Wilful Blindness, and one of the things I learned doing the research for this book is that companies packed full of super smart people make gigantic mistakes. Now, we're in Cambridge, and we really like to think that we're smart, right? I mean, I'm a Cambridge graduate. I like to think that I'm smart. And we think that being smart is enough. And if we're really smart and we work hard, everything will be fine. And I think the moral of the story of Willful Blindness, in a way, is you can be super smart and still get things spectacularly wrong. BP is full of smart people who for years have got things spectacularly wrong. The music industry is full of people who just argued until they were blue in the face that digital music was never going to be a threat. Everything was going to be fine. Vioxx, Merck is a company full of super smart people who are absolutely convinced they had nothing to fear. So I would start by saying, when you're thinking about raising money, take a big, deep breath and try to be humble. Because you're going to go out and you're going to start selling and you're going to feel, I have to be really confident and really sure of everything. And that's true. But inside in your company, when you're looking at yourself in the mirror, have a little humility and think hard about, where am I going wrong? Where are my weak spots? What are the problems here? In particular, think hard about your competition. I've lost track of the number of companies that I talk to, and when I say, who's your competition, they say blithely, I don't have any. Now, there are 2 problems with that answer. One is, they're definitely wrong. And the other is, if they're right, it's because they're in some dead space nobody wants to be in. Having no competition doesn't mean you're brilliant. It usually means you're alone in a place that everybody else is smart enough to stay away from. So start with some humility and acquire some very friendly critics. Because when you're going to go out and raise money, whether it's from a bank, whether it's from your mother, or whether it's from venture capitalists, you need to feel very confident about your pitch, and the only way to feel confident about it is to rehearse it in front of critics. Not your friends, not your co-workers, people who have your interests at heart, but who are prepared to tell you the truth. I work with lots of startup companies. I walk in, they are mostly populated by people who look and dress identically. That means they're not going to give you really tough criticism because they're like you. They're not going to give you a really objective insight into your pitch. So find some friendly critics who are different from you and rehearse your pitch. Because if you can do it well with them, you can do it well with others. But be very careful about rehearsing and planning with people who are always going to agree with you. The second thing I'd say, Jamie talked quite rightly about due diligence. The importance of due diligence is that you truly understand before the meeting, and subsequently if you're in negotiation with investors, who you're talking to. I know some venture capitalists that I won't name but that you probably don't want to do business with. There is a very wide spectrum of ethical standards in the investment community. And the best thing to do is find other companies who are in or have been in that VC's portfolio and talk to them quite honestly and totally off the record about what the experience has been. I've done that myself, and I have been seriously warned off particular investors. And it isn't necessarily that they're just good guys and bad guys. There may be some companies that aren't great for you but are great for somebody else. But just having long discussions with the VCs won't give you the insight you need. Talk to other people who have had investment from those VCs and find out what is life really like. It's a little bit like a marriage, and you do kind of want to see who these guys have dated in the past and what went wrong. And people will tell you. People will tell you. The other, of course, the important thing here is, you know, my 3 high-tech companies were all in the States. All my venture capital came from the States. That doesn't have to be a problem if you're based in the UK, as long as your business is truly global. But again, you need to understand that there are very significant cultural differences here. And the easiest way that I would summarize that is that in the UK, people make relationships first, and then they do the deal. In the US, people do the deal, and then they build the relationship. That means when you have meetings with people in the States, they do expect you to cut to the chase. What that means for you is you need to have done a lot of due diligence before you turn up, because they're not going to give you a lot of get-to-know-you time. It's just not the way that business is done in the States. So you have to do a huge amount of research, a huge amount of due diligence, really work your network to find out who knows these people, and who knows these people who will tell you the truth about them, so that by the time you walk in, you know them better than you know yourself. And you know what they're looking for and can talk to that. The third thing I'd say is not all money is equal. So £1 million from one investor is going to be worth a lot more than £10 million from a different investor, because of the strategic relationships and the expertise that those investors have. So there's strategic money, and then there's cash. Now, they're both wonderful, you know, don't get me wrong, but they're very, very different. Strategic investment in particular, if you can find it, is important for 2 reasons. One is a strategic investor will open doors for you that may otherwise prove very, very difficult to open. They may open doors in terms of partnerships, strategic alliances, and customers. Again, due diligence is going to be very important. Make sure when they say, oh yes, you know, we can get you into ... make sure they have a track record of actually having done that. But strategic money will always be more valuable to you than pure cash. And don't be too hidebound about how that strategic relationship may work out. I've written very extensively about one of my favorite companies in the States, which is Chipotle Mexican Grill. And Chipotle Mexican Grill is a very high-end fast food chain. It's valued at over $1 billion now. And it was initially funded through angels and friends and family. And then Steve Ells, who founded this business, did a jaw-droppingly daring and brilliant thing. And he took a gigantic $350 million investment from McDonald's. And everyone thought, well, you know, that's the end of Chipotle Mexican Grill. It wasn't. What he wanted from McDonald's wasn't just the cash for rapid expansion. What he also wanted was their expertise in how to scale to be a gigantic business, and particularly, and very specifically, how to manage gigantic numbers of real estate transactions. He got that expertise from them. He did his IPO, and he bought them out. It's one of the most dazzling pieces of investment I've ever seen. Now, lots of people, when he did the deal with McDonald's, thought, you know, he's organic, he's good food, he's quality food, you know, he's now sleeping with the devil, this is the end of life as we know it. Actually, it was the most brilliant move he could have made. It's hard to imagine where he could have found a combination of expertise and cash. Now, obviously, he structured the deal very carefully. But it's very important not to be too hidebound about who are the good guys and who are the bad guys. The other thing, which is, it's hard to imagine when you're absolutely on your uppers and you're trying to figure out how you're going to meet payroll. But you have to think hard about how much money is too much and how much is too little. And I'll explain why. If you get to, as Jamie said, and he's absolutely right about this, searching for money is very, very, very time intensive. It's also often kind of demoralizing and dispiriting, but mostly it's just incredibly time intensive. If you take lots of small investments from companies, or from individuals, or from organizations, two things happen. One is the transaction costs are very high, and the other is the time costs are very high. And the time cost continues because now you have to manage these relationships. So taking lots of small amounts from numerous investors creates a management overhead that can crush you as the company grows. But the other thing that's very counterintuitive is there is such a thing as raising too much money. And I know this because I've done it. I raised $100 million. I thought I was the most brilliant person on earth. And actually, we had so much money that it created an absolutely toxic culture within the business. Because now everybody became very greedy. We had kind of severed the connection between cause and effect, customer and business. And we were spending more creatively than we were making. So think very, very carefully about exactly how much do I need to achieve what. Just because someone's going to write you a gigantic check doesn't mean that you should take it. And further, to Jamie's point, of course, you may sell a lot more of the business than you actually need to sell in raising that money. The more of your business you hang on to, A, the more money you make for yourself, but also, B, the more of the company you have available for your employees, which will make a very, very big difference to the company culture. And the final thing that I would say is listen to no. You'll have lots of meetings where people say no. And apart from wanting to go to the pub afterwards and drown your sorrows, the important thing to do here is, first of all, find out why they said no. One of the best entrepreneurs I've ever seen, Carol Vallone, who built a company called WebCT, her first round she got a lot of no's, and the second round she went back to a lot of them and secured that investment. She had listened very hard to what their investment priorities were, and when her business was positioned to suit them, she went back and said, you always said this is what you were interested in, this is what we now are. She was also very comfortable saying, okay, I understand that this isn't right for you. Is there anybody else that you think might be appropriate for this business at this time? All investment is selling. That's basically what it is. You're selling a chunk of the company in return for some money and hopefully some expertise. So think hard about your customer, to use Jamie's word, empathize with your customer, and think hard about how your business looks from their perspective. The classic thing that ever since I made the strategic error of doing Secret Millionaire that I've experienced, is people come and they talk to me all about them. And they tell me how brilliant they are and the brilliant things they're going to do, and they haven't the faintest idea what I'm interested in. So really think about, if I were this investor and I had some money to invest, why would I be interested? You'll get one chance. And if you're talking to somebody who you appear to understand, that conversation can continue. And if you're just doing your elevator speech the way you've done it to everybody else from boot camp onwards, nobody will take you very seriously. And finally, to the few women who are in this audience, I would say, you will be wondering, am I at a disadvantage because I'm female? And the answer is yes, you are. Because people tend to invest in people like themselves, and the number of VCs that are female is tiny. It's under 10%. However, the good news is this. Everybody will remember you. Absolutely everybody will remember you. And that, I mean, trust me, it's a huge advantage. VCs sitting in Menlo Park see guys with polo shirts and chinos all day, every day. A woman walks in and they think, oh, that's nice. So, you know, maybe that's not the reason you want to be remembered, but it's absolutely to your advantage. It was always to my advantage. It simply meant when I was at a conference or at some sort of round table, people knew who I was and conversations would continue. So yeah, it's a pain in the neck that there are so few female VCs, but the more successful businesses we build, the more of us there will be. Thank you very much. Well, I mean, the first thing I'd say is, you know, from an IPO perspective, of course, it has been a dead duck. On the other hand, there is a great, glorious tradition of businesses started in recessions. It's a fantastic time to start a business. It may not be a fantastic moment to exit, but it is a fantastic time to start. And, you know, many of the greatest businesses have been started in recessions because there's more talent available, it costs you less, you may get deals with suppliers and vendors more cheaply. You may get access to business partners who in a boom time wouldn't even talk to you. And you have a market that generally is starved for innovative products. So, you know, there's a great deal that's fantastic about recessions. Personally, the fact that the IPO market slows down, I don't regard as horrific, because I think there are a lot of really poor IPOs in boom times. But it makes it just all the more important that you have a real business.
Yeah, I think the only thing I'd add really is that, of course, most VC-backed exits are not IPOs. It's the IPOs that we tend to hear about and create the headlines. And I also agree that there can be some pretty disappointing IPOs where they come out and then the price drops, and that's not really benefiting anybody. And I have to agree, there's nothing like starting a business in a recession. It just starts all those good behaviors from day one. I also agree in terms of the quantum of money you raise, all the good startup companies, the entrepreneurs I've seen, they take a certain amount of money, they say it's going to last for X, but somehow or other it always lasts for X plus 20 or X plus 30. They just manage to eke it out and eke it out. And recessions are good times to do it. Now, there's another structural issue, and that is that as industries mature, you get consolidations. So if I look at the mobile phone space, for instance, there are a small number of mobile phone companies that really have the space. Trying to sell to those is much more difficult than if there are 30 all vying for business. So those sorts of structural issues need to be considered, but that's a structural issue. It's nothing to do with recession and downtime. Well, actually, we do have the odd multi-billion-dollar exit. You know, if we look at CSR or ARM or whatever, those are the billion-dollar exits. So it's not a question of courage. I think there's a question of size. What's the industry base like? Where are the customers? And in the US, you have potentially more of the expertise concentrated in one place. In terms of behaviors, I do agree with you that it's wise for VCs to keep some powder dry, because the worst thing that can happen is if you're investing in a company and it just needs another 10 million or something more, and if you don't put the money in, someone else will, but they'll then cram down, well, they potentially will cram down the other investors. So there are some behaviors amongst VCs that stop VCs from just sort of putting all their money into a company and then hoping that other VCs will come in and be nice to them later. Doesn't happen. But that's prudence. I don't see a problem with it. You know, there's no point in putting money into a company if you're not going to make money back out of it, is there?
I mean, the only thing I would add to that is I think this is a generalization to which, of course, there are exceptions. But I would say that my observation is that British companies often think small. They think about, I want to be able to exit at this and retire to Spain. I have to say, in all my time working in high tech in the States, you know, nobody was talking about retiring. You know, the worst that's going to happen is I'm going to make a huge success of this and then start another one. I was interviewing Jack Dorsey, who's one of the founders of Twitter, the other day. You know, he's already started his next company. So I think, you know, what you see in the States is a tendency to think big, which sometimes comes across as brash, but it's really thinking big from the get-go, and thinking, especially if it's to do with the internet or to do with, you know, technology, this is necessarily global. And I think that I don't see that from the outset in British businesses as much.
So, sorry, just to add to that, actually, one of the common concerns, there are lots of concerns I have when I get people come to me and pitch, but one of the concerns is they say, look, here's a big market and we can get 5% of it, and that's going to be great, isn't it? Well, I mean, when we show them the door, they wonder what's gone wrong. Well, the problem is that, I use a slightly different term to the one you used, but I look for egoless ambition. I want people who really want to make something happen, but it's not because of them, they're not trying to promote themselves, but they want to create something, and they want to create something big. And I think if you look at some of the companies and there are fewer companies in Europe that have done it, that spark, I agree, has been there right at the start. You can't plan to go to the moon by saying, let's go down to Brighton for the weekend.
Yes.
You know, it just doesn't happen.
Yeah. No, that's really funny. I mean, one reason I moved to the States is, you know, if you mention global domination in the UK, everybody goes, ugh. You know, you mention it in the States, everybody feels really comfortable. Now, you know, that's kind of, you know, from a political perspective, that can be a little unpleasant. But, you know, you want, I mean, if you're going to dream, you know, dream big.
It's funny because you remind me, we, in a company I helped found, we used to talk in the early days of world domination. Clearly they can't talk about it now because it's anti-competitive, but that's the sort of, you know, you go in, and sometimes it's a joke, but it's those sorts of things that inform the culture, not just of the team, but the founding team, but the rest of the people. That's what attracts good people. You're not going to go and work for a company because they want to open a corner shop. You're going to go and work for a company because they are going to be the global suppliers of widgets, and that becomes an opportunity because those individuals can then grow with the company as well.
So in my early career days when I was at Cranfield, as a lecturer, I went off to do some research on so-called super growth companies. And I went off to California where my cousin was working for Netscape. He then gave me an introduction to somebody to go and talk to about growth and ambition. And I asked the question, so what are your growth plans for this company? I presume it's sort of small business that you're intending to grow. And he kind of looked at me strangely and said, no, we're not a small company with ambitions to grow at all. We're just a big company starting small. I was the CEO of Sun Microsystems. And he had half a Volkswagen up on his wall. So I think there is a really, thank you for that question.
Well, we don't do it secretly. If we're going to do research into someone, we tell them. And we don't set an expectation that says, look, we're going to investigate this, and then we're bound to invest. We say, we're interested in this space, we're interested in what you want to do. This is going to be a joint journey, and we want to make it and be interested in it together. One of the things we do is in my organisation, we right at the outset have got an investment strategy that looks at which markets we think are going to be interesting and why. if we don't see business plans come to us, we will approach people. And I have sat down in some anonymous hotel in Boston with a French guy and an American guy, and it was like the worst place for all of us to get to, and spent a weekend. And we produced a business plan, not a business plan of hundreds of pages, but actually a couple of sheets of paper on a whiteboard, which I still happen to have somewhere at home. And that's what we used as the basis of our decision to invest. One of the things we do, because we look at these things operationally, is we talk to contacts we've got in industry. So have you heard of this? Is this a problem? If I had a solution for you, would you be interested in it? You know, the classic open questions. And most industrialists are only too pleased to talk to VCs because that's where they do get some of the interesting technologies that they can then take on and be even more successful with.
I mean, I think the key is it's a collaboration. It has to be a collaboration. It's not a tennis match, you know. And if you can't collaborate with your investor, then it's probably not the right relationship.
So you mentioned earlier on that it's a bit like a wedding. Actually, our view is that no matter how good the business idea, if there's no chemistry there, it's the wrong thing to invest. And we'll be honest and we'll say it. And it's not we're bad, they're bad, anybody's bad, but there's got to be something, because you are going to be with them for a long period of time. We all get caught up with the idea that companies somehow suddenly become fantastic and worth lots of money, and that happens almost overnight. There are very few overnight successes. Most of them, there's a lot of blood, sweat and tears, and the VCs are part of that journey. So actually, let me sort of clarify. I personally really like the idea of a customer as an investor because they buy into your technology. They want to give you money to do things, to get something from you. They want to buy from you what you're selling, not as an investor. However, strategic investors also have a role, and a good strategic investor is very important. For ARM, Apple's relationships, they were building the Newton at the time. They had a relationship with Sharp, who were also going to build the Newton. They became one of ARM's licensees. So you can use referred sort of relationships in order to be successful. But when it comes back to how do you build a normal customer-buyer relationship, well, one of the things you can do is do some consulting with them. Now, I'm a great believer in having a strategy, a vision of where you want to go. But if you've got to take some small steps to get there, maybe you do a bit of consulting work with this company. Maybe that helps them understand you. Now, what I would also say is if you're going to do this consulting work, it should be something that will get you along your strategic path. You have to be very aware of the IP issues. But again, ARM did consulting work for Apple that got it moved further forward. It did consulting work with TI, one of its licensees, that helped it move further forward. And did these things make lots of money in the short? The simple answer is no. You can't go and suddenly have huge markups on what you're doing, but did they give us very valuable input and huge levels of credibility? Absolutely.
This is going to sound really arrogant. I'm very action-oriented. So I don't remember, and maybe it's, you don't remember pain, so maybe I've just forgotten. I don't remember decisions being especially difficult. I remember some of them being wrong. But I'm a big believer that you make the best decision you can at the time, and if it's wrong, you learn from it. So I think, at risk of sounding very loose, I think I think you have a business plan and you do your best to execute it, but you also improvise a lot, because when you start a business, it's the moment at which you know the least. So then you make some decisions and then you learn more. I think probably the hardest thing for me, at least in my first high-tech company was realizing that I couldn't simultaneously do everything I wanted to. So I couldn't go after the entire global market with 25 people. And that I had to start in one place and focus on that. And the decision to focus and stop thinking that I could hedge my bets, I think was essential but a little painful. But I am a very big believer that you think hard, you have lots of discussions, you make your decision, and then you learn from it.
You gave me plenty of time to think about it, but I still can't say I look back and... I mean, there are tough times.
Yeah.
One of the things that a lot of people don't realize is how much emotional energy is used in pushing a company forward. And sometimes you're pushing other people forward, and sometimes you need a bit of a push forward yourself. There are tough times. You worry about making payroll. You just do. You don't like laying off people. It's a tough thing to do. But I have to agree, we didn't rehearse this, but I'm a great believer in it's better to make a decision and move on than this paralysis by analysis. And again, I hate to say it, but very intelligent people can sometimes get hung up in the analysis and forget to move on. And it's much better to move on. Oh, that was the wrong decision, we won't do that again. Poof. And I guess that's a sort of cultural thing. I guess in the US you tend to see, you make a mistake, as long as you've learned from it, that's a badge of honour. In the UK, you've made a mistake, it's, a bit sniffy about this. And I think, it's actually the mistakes we learn more from than we do the successes.
Yeah, my first investor said to me, Margaret, I don't mind you making mistakes, just don't make the same one twice.
I think there are two types of errors, I think, which can become difficult. Saying yes to a deal that turns bad and saying no to a deal that's really, really good. And that's the biggest mistake, I think, of all, is actually turning down opportunities that might turn out to be interesting.
Well, what we've got is we have a spreadsheet that basically models how many companies we think we're going to invest in. Pond is both seed and early stage investor. And clearly we aim to go through with our companies. But we look at how many we think we're going to succeed, how many we think we're going to follow on, when we're not going to follow on. But ideally we want to see a couple of plus 10 times returns. We expect then a few reasonably strong exits, and then we expect to close the rest down. And depending on the circumstances, you look to return your fund plus a multiple of several. And I'm deliberately hedging my bets at the moment because life is a bit tougher at this particular point in time. But it's still possible. We're still seeing exits that are reasonably healthy, just not quite seeing as many of them as we'd like. I wouldn't expect to invest $1 million and get anything back. If I invested just... this is a good point. If I invested just $1 million, then that wouldn't be enough capital deployed. And so in my mind, if it's $1 million and it's not going anywhere, that's it. Even if we got 10 million back, it's still not a good return on time and energy. What you really want to do is you want to invest 25 million over a period of time, over several stages, and then you want to get back 250 million. Those are the margins that make the needle go. It's not you invest 25 million and you get 30 million back. That's not a success. It happens, and it's not a failure, but it's not a success. I guess, why are you overly worried about what VCs think? What's the right thing to do in terms of driving your enterprise forward? And I have a friend who's been through several companies who's doing exactly that at this moment in time, because what he actually knows is he wants to get something substantive that he can say. In sales terms, you talk about touchy-feely. So what I mean is when you're trying to sort of do a pitch, take along something that the customer can look at. Well, as a potential, as someone who's seeking investment, if he can take his idea and actually say, look, I built one, it works, that's going to get him a huge amount, much more attention than if he goes along and says, well, I've got this idea, please put $1 million into my company, and I'm now going to give you an awful lot more equity than I would like to. So if you want to get in the driving seat when you're driving your enterprise, don't be driven by the people funding the company. Right. Take their advice, work with them, but you want to be, well, I imagine, the only reason I got into business was because I don't like being told what to do. That way I get to avoid being told what to do.
But the other thing I'd say is that if you aren't prepared to do it for nothing, then there's a limit to what anybody's going to be prepared to give you. If you're not prepared to invest in yourself, nobody else is going to invest in you either. The other model I have seen a very great deal of is couples who start businesses, and one of them keeps the day job, while the other one is starting the business. And once the business is sort of viable or has some revenue, only then does the other spouse quit the day job. So essentially the investment there is the salary. And it actually works extremely well. I've seen it in many, many instances.
It's funny, actually, I'm just going to say, Shai and I were talking about this very point. At the beginning of, if either one is going to get involved in something, you've got to be able to agree how you think it's going to pan out. It's just so important. If you can't agree with in your relationships what you're going to do and how it's going to parcel out, then trying to then drive it on with VCs and such like is impossible.
Yeah. No, it's interesting because my husband's an academic and he has a very, very sort of slow, steady job. And that's been fantastic because I always knew if all else failed, we wouldn't be homeless. But he had to commit. He had to commit to the roller coaster ride. And I couldn't have done it if he hadn't been willing to take the knocks when they came. Well, my first investor, who is American, and who regarded me as British, although I'm not by birth, but he thought I spoke funny, so he thought of me as British. He had a phenomenal boatload of prejudices about British in particular, but Europeans generally. And they were, you don't work very hard. Nobody works at weekends. Everybody takes long vacations. It's all too laid back. There's all this relationship mumbo jumbo. There isn't the fire in the belly, and you think small. And and this is a brilliant, brilliant man. But there are these prejudices about Europe in general. Donald Rumsfeld's description of Europe is full of all those people who didn't get on the boat. That Europe likes a secure safety net. We're not risk takers. We don't have this burning desire to succeed. So it's worth accepting that is a prejudice you may well encounter. It is, as I can demonstrate, it's overcomable. I think it's also fair to say that Americans generally think that Europeans are very well educated and tend to be very good communicators. So, there's a little bit of prejudice in our favor. But you have to accept that, the Rumsfeld thing nailed it. It is what a lot of people think.
It makes me wonder what you think about Australians. They had to get on the boat. Actually, I guess one of the things I like about business life is I've had to do business around the world. So, the Koreans, the Japanese, the Chinese, West Coast America compared to East Coast America, it's all different. And all I'd say is empathy. Understand where the other person's coming from, and then you might be able to break down some of the barriers that fairly or unfairly exist. But I think just to set things in perspective, one of the challenges you will have, if you're based in the UK and you're trying to sell to a guy or a woman on the West Coast, then why should they try and invest across N time zones when they've got lots of opportunity in the US, you've got to be something special. And the same is true in reverse. If you're based in the UK, why are you going to invest in a US company? Or why are you going to invest around the world? And most VCs are not specifically geographically restricted, but they tend to tell their own LPs, their own investors, that they're going to focus on a region. And at Pond we do, but somehow we focus on Europe, but we've got a couple of investments in the US and in Israel, because you can't let a good opportunity go begging.